Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Welcome everybody to the July edition of the FX Monthly Webinar. Going to do it slightly differently today. We're going to hand over straight to Piers. He's got a lot of interesting things to say now that we've had the end of the second quarter, what that might mean for the coming quarters. So we'll start with Piers. He'll do his charts, and then we'll flick over to me, and I'll do a review of the fundamentals and we'll look ahead to the remainder of 2023 and into 2024. So Piers, without further ado, over to you.
Thanks very much, Neil. So today we're going to look at the quarterly charts, and I'll also cover the FTSE today in addition to the FX markets. And also we have quite a significant break on sterling to talk about. But if we go to the next slide, this is something I saw last week when I was on my way to Basildon, down the road, the A127. I saw this sign, a sign warning me Christmas is coming and to book now for my Christmas events. I thought, oh, that's a bit early. Then I realised maybe it's not. We've come to the end of the second quarter, so now we are in the second part of the year. We're heading into the second part of the year, and it's important to know each quarter as it goes by that time goes by quickly. Time waits for no man, and it's going on. So we're closer to next Christmas than last Christmas. And no, Michelle, it's not just because Christmas sales are coming. It's important because the quarterly charts often give us good signals as to where the range could be, for the next quarter. And then we've got the last quarter coming up, which is always quite an interesting one. And that's been the case over the last quarter that we just had. We gave ranges, I gave some technical ranges, and they all seem to have held quite well for the whole 3 months. And so that's one of the advantages on these quarterly charts when we look through it. So here we go. We're going to look at the start of the second half of the year. I'm going to start with everyone's favorite on the next slide, the dollar index. So this is the chart that we had on last time, and it shows the Bollinger Bands going round the price action. We'd moved back into the Bollinger Bands, and I said there was a lot of different support in the 97-100 area, which should produce some buying interest as price moves back down towards those levels. I said resistance should be on the 105-106 area. And if we look at the next slide, we can zoom in and see how did that work. Well, I think it worked very well. And that's the advantage when we look at these quarterly charts. The low was 100.75, so the top of the support area we gave. The high was 104.70, so just below that 105, 106 resistance area we gave. Now, this quarter always is a bit harder because you suddenly hit the holiday period of July and August. But last quarter was a positive quarter, and that was after 2 negative quarters. Price found support where it was supposed to find support at the top of that 9700 area. And I still see that as support, but I still see the 105, 106 as resistance. And that's the area. If the bulls are going to rally off this area and have a move back higher, they need to take out that 105, 106 area. So I think we might see maybe a bit of a rally in July. But the real key will be, can it hold any rally if it does rally to start this month? Can it hold it into August? And there's a risk that you get this move up and it starts to fall in August and comes back down. So I will keep you posted next month. But at the moment, we start off with the same levels that we were watching before. Maybe I'd put 104, 106 as resistance, and I'd put initial support at 100.7580, just where it bounced off last quarter. So that gives us 2 levels just to sort of start to watch off. And I'll probably watch during the second half of the quarter, as the quarter progresses, the 103 and a quarter, 103.50 area. If the bulls can't hold above that area, then it would be a sign of weakness. Where does the dollar strength wane? Back below 100. That would be a worry. If we got below 100, be a worry for the dollar bulls. So we go to the next slide now, is euro dollar. So on euro dollar, this is the chart I put up last month, and I said any quarterly close above 110.75 would be significant development for the euro dollar bulls. And we had resistance at 111 and 112.75. I had support, I said, was around 107.60, 70, and stronger support at 106.10, 25. The low of the last 3 months for the last quarter was actually at 106.34. So that support area worked really well. So the strong support held as the market bounced nicely off it. But to progress forward, we need to see the 38.2% on this monthly chart taken out. And that comes in just there at sort of the 110.75. I put 110.95, get a bit of breathing room. So again, that's going to be a key area. We need to see a monthly close above 110.95, 111 to open another move higher. I think July will be jumpy. Remember, this is the year of the rabbit that we've said from previous webinars. That jumps around. So I think you could see falls in euro dollar that get bought into in the second half of the month. But I think August is the month of risk and could see some more strong pullback lower if we do get a rally in the second half of July. But I'll update that on August webinar. So this quarter, I see support in the 105.50, 106 area, and with resistance again at 111. And then if we look at the next slide, I'm going to bring in some levels here. This is the quarterly chart. So if we look at the long-term trend line going up, we broke that trend line. We're coming back up to it. I had this on the webinars before saying should be resistance. That trend line comes in about 112.5. The Bollinger Band comes in at 111.80. So that's going to be a tough area if price gets up there. So that to me is a risk that you see us sort of move up towards that and then a sell-off. If you get above 112.50 on a quarterly close, then that's very positive for the euro dollar bulls. But at the moment, I'd say resistance at 111.80 and then resistance at the 112.50, 112.75 area. Where has this actually failed already and it's breaking down lower? If we see price below 105 at any stage, I think that would be a significant break of the rally from last year. So risk a jumpy July and then maybe a strong directional move in August. And I'll cover that in the next webinar. So if we go to the next slide, I'm going to go quite quick. If you've got any questions, you can always come back, but it's just because there's a lot to get through. So this is the big change for me. If there's one slide I was going to look at today, it'd be this, the sterling index. So I said on the last webinar, well, actually back in 2022, I put that with that big spike, I said, will this spike save sterling? And it looks like it is. We sort of formed a bit of a triangle, the blue dashed line as the base, and then the 38.2. So that 38.2, I've marked all those quarters, held sterling for 12 quarters, ever since the collapse of 2016. It's not closed above it. Last month, I said, look, the real shock could be is if sterling does break above the 38.2 and the top of the Bollinger. And that shock has happened. We've broken above the 38.2% retracement and held above it for the first close since 2016. Now that's significant. You had that big spike, you've got a good move up. Each quarter's got stronger and stronger. The first quarter after that big spike was a small green body, and then a bit of a larger body, then a even bigger body. So it's like, they call it advancing soldiers, but it's a strong move, and we've stopped at the 50%. So we might see a bit of a pullback off that 50%. But for the moment, while price dips can hold that 38.2%, then the risk is we go up towards the 61.8%, which is the 69 area. So over the next 1 or 2 quarters, while dips lower are held by the sort of 65, 38.2% retracement, sterling should have good support. Now, we always have to be ready for a shock with sterling, I always think, because sterling always has the ability to suddenly collapse for some unknown reason, something comes out of the woodwork. So we need to know, where would we change this view? Where does this positive feel go? This positive feel would go if sterling got back below 63.50 for me. Then I'd be worried. While below 62.30 would completely break the positive feel from last quarter's positive rally. So I put on there in red, break, can it confirm the hold? So what you need to see when you have a break is that it holds the break. So rule of confirmation, you need 2 closes above the break. So I'd like to see it above the 38.2 at the end of next quarter. So how does that transfer into the currencies? If we look at the next slide, we have sterling dollar. And on sterling dollar, this is the monthly chart I've had on for some time. And I highlighted this last month. Well, I've highlighted it every month for all those circles we call the rule of polarity across the middle. So when price was above that, it acted as support. Every time it came down, it got bought into. Now, for the first time in 2022, we broke through that and collapsed lower. Then we saw price go back up and it acted as resistance. So it swapped from being support to resistance in the green circle towards the right-hand side of that chart. And it held it. That 2360 held it for 4 consecutive quarters, 4 consecutive months. Now, we were just breaking through it on last month's webinar, and I said, look, if you hold above this 2360, the risk is we go up towards 126.70 and 127.75. And we can see we've had that move up to that 127.75. So it didn't manage to close above that. That's the 61.8% retracement around the 127.60 area, and it backed off that. But what we know from this chart is that that 123.60 area should be support. It reasserted itself as support for the last 2 months, and again, it's there. So while above 23.60, it's positive. Below 23.60, then we have to worry. If it can get above 27.75 on a monthly close, then we could potentially see a move up towards 131, 133 area. But we need to see a monthly close above that 127.75 to open that up. Now, this is monthly, so I can update that next month and it will be quite good. But if we look at the next slide, what we're really looking at on these charts is the quarterly charts. So the quarterly chart hasn't turned positive yet. And that's because we've come back up, but look last quarter where the high was, right on that 20 moving average from the Bollinger Band. So I'd really like to see price above that on a quarterly close to get more positive longer term. So this could be a monthly move up. You might see a short-term move up and then come back down. To get longer term committed that sterling dollar's going to go higher, I'd like to see a quarterly close above that 28 and a quarter area. And so that's what I'm going to keep an eye on during this month. I will keep you posted on the monthly webinars and on the charts I send out. Where would sterling have failed on this attack higher? Where are we going to see it moving back lower? If you get below 123, then I think it's had a bit of a body blow. Something's gone wrong for it. So, but having said this, keep an eye on my weekly charts, because I think the weekly charts are getting to a stage where over the next few weeks, we might start to see a short-term move on the weekly charts come back down. So we can't be complacent over the summer. We need to keep watching how this plays out on all different timeframes. That's sterling dollar. Let's move on now to the next slide. The next slide is euro sterling. Neil always tells me more people like to do sterling euro. So the euro sterling chart's in there, the levels are there, the commentary will be in the pack that you get sent out afterwards. But I will go through the next slide instead, which is sterling euro, so people can sort of see the levels. At the end of the last webinar, quarterly webinar, on the last quarterly webinar, I said that 1175, 113.25 area should be support with resistance in the 116, 118.35 area over that quarter. And I think those levels work really well because the 111.75, 113.25 support worked well because the low was 112.65 and price tested up to the 117.40 area. So mid that 116, 118.35 resistance mentioned in April's quarterly chart webinar. So where would I watch now? Well, I think for now on sterling euro, I think I'd move the support area up and say, look, moves lower should find support now in the 113.80, 114.80 area. And where would resistance be now? I think resistance should be in the sort of 118, 119.50 area. And those are the sort of levels I'd watch this quarter. And then if you watch next month, I can try and update if we're starting to see any breakout of that or anything. But those are the levels I'd watch for this quarter going forward. And the final thing was we got asked about FTSE, and I said I'd put the FTSE. So the next slide is a FTSE chart. And I have three very quickly to go through. The first chart is just to show the Bollinger Bands on the price action. So price has been from the 20 moving average, it's broken above that, and it went up to the top of the Bollinger Bands, and it's stalled. But the overall thing here is you still have an uptrend at this stage. But what I was going to say is if we zoom into the next slide, you can see, actually, I'm not sure if, can we just look at the next slide very quickly, or we might go back? I'm hoping I've zoomed in one. So if you look here on the very last candle, you'll see that it's didn't make a higher high than the month before. So suddenly you have an inside session. So I just think that maybe this move is starting to struggle. So we go back 2 slides. It's not so clear. Yeah, you can just see, if you look again, it's not so clear on that one, but you can see you've got an inside session. So maybe a bit of a pullback lower, maybe a test down towards the support in 7,100, 7,300 area, and resistance should be the 7,700, 7,850 area. So where does it start to look ugly overall? I think only if it got back below 66.40 would it look like a stronger pullback unfolding. So we go to the second chart, the next chart, sorry. This just puts the extension swings on. We can see we're in an overall uptrend. You can see the cloud, there's a trend line. Every time price comes down, it hits that trend line. Even 2020 bounced off that trend line, hit the bottom of the cloud, rally. So pullbacks lower, I would expect to find support in that sort of cloud area or that trend line and come back higher. The third chart, the last chart, and all this is showing a slightly different extension, and it shows really why we're stopping at this level here. It's because if we look at the last move from 2020 up and then the pullback down, you can see that we're stalling at the 38.2% extension. So that 78.25 is where you need to see price close above to re-engage the upside. If we look at the bottom, I've got an RSI and a slow stochastic, which also both sort of suggest that maybe price is just finding it a bit hard to go higher, and there's a slight more risk to the downside before we see upside. But I hope that helps. I'm going to say there's a disclaimer on the next slide. And Neil, I'm sorry, I've run over by 3 minutes, but there was a lot of charts there. If it was too fast, you will get the slides sent out, and also always ring your salesperson. They can put you in contact with me, and we spend a bit more time going through if you need. Thanks.
Thank you, Piers. And once again, very, very interesting, insightful stuff from the technicals that I hope these webinars, I certainly don't know of any other webinars that cover technicals in the detail that we do. And I think it's a real differentiator. So Piers, thank you again for your contributions. Straight over to me, and I'm going to deal with the economic outlook. So we're going to look first and foremost at some of the material changes that we've seen in terms of economic activity, looking particularly at the PMIs. Then we'll look at the labour markets, because that does seem to be a key concern of central banks, before looking at central bank action themselves and what they're doing. Finally, I want to focus just a little bit on inflation divergence and why I think that is becoming interesting, and summarize all of that into how our currency views may or may not have changed as we head into the second half of the year. So let's go straight into the detail with the next slide and the PMIs. What we're seeing here is a clear trend across all of the major jurisdictions. So all of the major economies here are heading lower in terms of activity levels. Services is above 50, but only just. Manufacturing is below 50 on virtually every single and expected to dip further. So I would expect to see some material weaknesses with regard to these figures. And the other point to note with regard to the PMIs is that they do tend to be a bit of a leading indicator of economic performance generally. So it might take a few months before this trend is evidenced in the data, and the data itself, certainly as far as industrial production is concerned, is pretty poor in any case. But service activity is where I think the battleground truly lies, and whether or not we see a downturn in activity there, which I think we may well. If we look at the next slide, labor markets. Now, I think there's a huge contrast here between the US labor market, which has effectively returned back to where its previous trend was, versus the UK labor market, where employment levels are down. They're down on where the peak was back in late 2019, early 2020. And I think that it does demonstrate that there is a material shift in labor supply as much as anything else. So although labour demand has not recovered, I think this may actually be a case of an inability of employers to find the right employee at the right price in order to maintain their employment levels. So I just think that's an important differentiator. The other thing I would have to say is that some of the trends in labour markets may still be driven by the fact that the cost of investment has increased disproportionately to the cost of labour. So labour is still seen as the cheaper option, which is why we might still be seeing the uptrend as far as UK employment figures are concerned. But there are some problems here in terms of that we are seeing in the UK quite a material upward shift in average earnings growth. We haven't seen the same thing in the US. In fact, average earnings growth has started to subside as far as the US is concerned. So we'll look at the data going forward as far as labour markets concerned. The latest non-farm payrolls release is due out on Friday. Will that uptrend persist? Will the strength of the US labour market persist? Or are there some signs now that employers are becoming a little bit more wary of employment with the economic outlook more uncertain? So we'll move on to the next slide now and look at the latest Bank of England decisions. Latest central bank decisions. The Bank of England here, clearly the outlier, certainly with regard to how much interest rate hike expectations have shifted in the immediate period preceding the bank's decision in June, and then the aftermath of it thereafter. So Bank of England raised interest rates 50 basis points. That was out of kilter with the Federal Reserve and the European Central Bank. Although the ECB did hike, they only hiked by 25 basis points. And as for the Fed, they've instigated a pause, but only a temporary pause by the looks of things, because they're already talking about the possibility of a hike in July. Well, if you're going to hike, why didn't you just hike in June? Why instigate a pause in monetary policy? It kind of muddies the waters there. The Bank of England as well have muddied the waters a little bit further in terms of sort of slowing down the pace of monetary tightening to then only speed it back up again. And generally on the back of things that were already in the system. We already knew that they were feeding through. A lot of the inflation inputs, a lot of the rise in services prices are coming off the back of events that happened many months, many quarters, or even a number of years ago that are now feeding through in terms of the additional costs facing those businesses. So raising rates now might be the wrong thing to do, because ultimately what we're seeing with regard to the performance of the UK economy is it's broadly speaking stagnating, and we're seeing very, very limited rates of money supply growth, a significant limitation as far as producer price inflation is concerned. I think that there is a real risk here that we see the Bank of England materially overcooking things in terms of rate hikes if they haven't already done so. And again, to use Sylvia Tenreiro's comments that she made of some of the MPC hawks, the Bank of England is increasingly looking as if it's at risk of being the fool in the shower, having turned the water on but not waiting for it to heat up or cool down before throwing yourself in and getting yourself scolded or a severe chill. So I do think the Bank of England are at odds with the rest of the central banking community. It's also noteworthy to see what we're seeing in Asia, which is and other emerging markets. We're starting to see the possibility, the prospect of rate reductions being vaunted and being trailed, and certainly the major central banks in the Western developed world are out of kilter with that trend. So we move on to the next slide. This is, I brought up a slide, I think either last session or the session before that, about money supply activity. Well, producer prices and consumer prices are also equally now diverging to the stage at which I think we are in danger of ignoring one in favor of the other, whereas one is a leading indicator of where the other will be going. Producer price inflation is falling in a number of countries. In Europe, in particular in Euroland, it's now down by over 1.5 percentage points. Producer price inflation in the UK is running at around 1%. In the US, it's running at around 1% as well. None of these are consistent with consumer price inflation still being at these very, very high levels. And in fact, we now have US headline inflation rates running at around 4%. Euroland headline inflation rates running below 6%. UK inflation is running at 8.7%. But it will come down over time. So I think this divergence between producer price inflation and consumer price inflation is interesting in terms of what it might mean for interest rate expectations in the medium to longer term. And whilst the UK may reach a higher peak, they may find that they have overcooked things more quickly, and the risks on sterling, when it is discovered that we've overcooked the monetary tightening, become very much swayed towards the downside. We're not there yet, but I think that this divergence between producer price inflation and consumer price inflation could be a key trend as far as the risks on currencies are concerned. Which leads me neatly on to my final slide, which is about FX market forecasts. You will note that not very much has changed in terms of sterling dollar and euro dollar, or indeed sterling euro. There are some changes with regard to our forecasts on dollar yen and also on dollar China. Our views there have become materially less positive on both of those currencies. The yen and the Chinese renminbi were much less positive. We have seen quite a material upside risk on both of these currencies, and this dichotomy between what's happening in Europe, where the dollar appears to be somewhat weak, and what's happening in Asia, where the dollar appears to be faring far better and has been strengthening, is one of those trends wrong? Is one of those trends going to correct? If it is, what does that mean to global pricing? At the moment, what you've got is the best of all worlds, potentially, if you're importing from either China or Japan, because you've got strength in sterling or strength in the euro, and also strength in dollar yen and also in dollar China. So suppressed global inflation pressures coming from Asia being imported into the European and US economies. A noteworthy difference from where we've been in recent periods, months or quarters, where all of the currencies have tended to move in the same direction. The UK, the pound, I think, gained around about 2.8% against the US dollar over the last quarter. Against the yen, the dollar gained almost 4%. So a real divergence there in terms of what we're seeing as far as dollar performance is concerned. Something, again, to keep our eye on into the end of the year and throughout 2024. I still think 2024 is going to be a difficult year for sterling. Been banging on about this for a while. They're just all of the stars have aligned over sterling strength in recent months and quarters, and I'm not sure what there will be to propel sterling to ever higher levels. I certainly don't believe that higher interest rates mean a stronger pound, not if it means damaging the UK's economic prospects further. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.